Welcome to your Mortgage Insider Update for January 22nd. We are a few days into a new administration and government, and so far the markets have really liked what they're seeing. We had an improvement in interest rates after hitting a high that we had not seen for quite some time. So basically, we went over the high of 2024, and then now have settled down, and we're going to take a look in a few minutes as the charts are starting to really become more favorable as the new administration starts to lay out their plans. They're going to put new policies in place. They're not going to replace the Federal Reserve chairman. The Federal Reserve is also coming up on their meeting. So as things start to settle in, we'll start to see how 2025 will play out. So we are hovering with the 10-year Treasury around 4.6%. This is better than it was, but not as good as it could be for sure. Up 3 basis points a day after improving yesterday. Mortgage-backed securities basically flat. So we take a look at both of these. You can see we're battling with the 25-day average. The 10-year Treasury actually started the day a little bit lower below the 25-day average, and what the black line represents as a Fibonacci retracement level. We go back in time. We can see that that level was last breached back in May of 2024. So we've gone above the highs of May and earlier in April 2024, and then have since come back down, and we're battling this level. We see most of the last half of 2024, 10-year Treasury rates were much lower than that. And then we can see the run up, just generally speaking, hopefully the high point of 2025 right here, but it is still early in the year. So we'll keep an eye on this week as this battle continues. We would like to see a couple days in a row below the 25-day average as a precursor to, futuristically lower rates getting back down to what would be the 50-day average. If we cannot breach below this today, we are at risk of going right back to where we started, back to the highs of about 4.72 seen last week. We will look at the mortgage-backed securities. Now, these are the prices the investors pay for the security at a 6% coupon. So as that price drops, the red would be bad. Interest rates to the consumers would be going up. As the price improves, the interest rate consumer comes down. So we can see that we had some price improvement over the last week since the January 15th. That was our low point in price, high point in interest rate back in the middle of January. And we've since got very similar to the 10-year Treasury, actually sitting right above the 25-day average here, but also sitting right on that Fibonacci retracement line. We can see this was actually a floor that kept interest rates much better back in late November last year. But now that we've reached below it, the concern again is if we continue down this path, if we get back into this level, it's a pretty far run that we could have negative on interest rates. But we do have kind of some things to battle here with both the 50-day average, 200-day average, all kind of above a ceiling or a point of resistance that could limit the improvement on interest rates until something newsworthy comes out. The next newsworthy items other than the Federal Reserve would be the personal consumption expenditure, PCE inflation. As that comes out, that could start to lean in a direction as far as the future of interest rates. So enjoy the rest of your short week here for Martin Luther King holiday week. We'll get into an update first thing Monday next week with kind of where we stand after the inflation reports and then after the prepare for the Federal Reserve meeting. Have a great day.